For some of you, this will probably surprise you, but CIPC and SARS are not as interconnected as you might think. Many business owners still assume that by ticking off CIPC requirements, this should cover them for all their SARS obligations. Let's break down why this misconception is so costly. Hi, I'm Shaun from Huntlogic Consultants. Today I'm going to save you potentially thousands of rands by exposing one critical error South African business owners make every day. Just last month, I had a new client come in with a 32,000 rand penalty from SARS. They were compliant with their CIPC filings, but they completely overlooked their SARS obligations. So in this video, I'm going to share with you what CIPC requires, what SARS demands, and how you can be 100% compliant with both. I've made a calendar for you with all the important dates for SARS and CIPC, and I've shared the link below in the description. So to start off, what is the CIPC? The CIPC is the Companies and Intellectual Property Commission. It deals with company registrations, the maintenance of company details. It also deals with intellectual property. We're talking about your trademarks and your patents. And it keeps a beneficial ownership register for all companies and close corporations. So for most of you business owners, think of CIPC as the official record keeper of your business's existence and structure. So 3 things you have to keep in mind when it comes to CIPC. This is where you register your company. This is where you need to also submit annual returns on the anniversary date of your company. These returns are your beneficial ownership filing and your annual return filing. Thirdly, you need to update the CIPC of any changes to directors or company details. So according to the latest annual report from the CIPC, an approximately 23% of companies were flagged for deregistration in the past year alone. That's nearly 25% of businesses at risk. The consequences of CIPC non-compliance are serious. Your company can be deregistered, meaning that legally it does not exist. This will affect your banking and even your contract. So now let's talk about SARS, a completely separate entity with different requirements. SARS is all about taxation. It collects the government's revenue using various tax avenues. So here's what SARS specifically requires from businesses. Firstly, company income tax returns. These are your ITR14s. They need to be filed annually. Value added tax. So every business that reaches a turnover of $1 million in a year needs to register for VAT and file its returns. Payroll taxes. These include your pay-as-you-earn and your UIF and SDL. And together with the income tax are provisional tax returns. These are submitted every 6 months. So the effects of SARS non-compliance are equally severe. You will face penalties of up to 10% for all outstanding amounts. Interest charges at the prescribed rate. Currently, that's 11.75% per annum. Potential legal action that could even involve seizure of assets and also being blacklisted for government tenders. But I think the one that takes the crown is what they recently introduced, which they call administrative penalties. These are levied for every income tax return that is not submitted, and these can range from 250 to 16,000 per month. This one consequence alone of SARS non-compliance is costing many companies dearly. So why do so many business owners confuse these 2 completely separate entities? One likely cause of this misconception is that during the initial registration with CIPC, business owners receive correspondence from SARS containing their income tax reference number. This automatic connection often leads them to think that these 2 entities are linked. Building on that, business owners might also think that because they have done submissions with one of these entities, it means that the information has been well received with the other. And lastly, because both entities deal with compliance, people tend to group them together. But that's like saying your driver's license and your ID are the same because both can serve as identification. According to tax professionals, this confusion costs South African small businesses an estimated 2.4 billion annually in avoidable penalties and lost productivity. So in the link in the description, I've created for you an annual calendar with key important dates for CIPC and SARS that you can use to your advantage. So I hope this video has clarified for you the important differences between CIPC and SARS. God bless.